So American National, the signature GUL, guaranteed universal life product. Okay, this product has its place when you're presenting to your clients. The sweet spot, I would say, is a client that wants more than a term, but maybe isn't really sold on the IUL. So the GUL kind of falls in between. They want that permanent long-term coverage, but maybe the cash value, maybe the indexing is a little too much for them. They're not interested. They got other stuff going on. They just want that permanent protection. Well, this product provides that, and of course, gives all living benefits. So let's dive in and take a look and see how this product works and what it offers. As we know with the National Life product, we have all the terminal illness, chronic illness, critical illness, living benefits that come with the product. I can go over those details. We all know what they have to offer. You can look into the rider guide about the details with that. Something to know with this product is the issue ages. Since it is a permanent product, usually we see these permanent products being offered at an earlier age, but for some reason the GUL starts at 18 all up to 80 for non-nicotine usage, and if there's nicotine or tobacco, max age is 75. So it gives some flexibility there. Some new things we've seen that's been offered with this product recently, and I don't know whether this is the COVID-19 additions and they'll go away, or if it's just something that'll stay permanently, but they've added a grace period of 61 days. I believe in the past it used to be about 30-something days, and now it's 61. And then they also have a late payment forgiveness 1 month beyond the billing date to give some flexibility with what's going on. So these are some new features we've seen added to the product as of late. The minimums are pretty good when it comes to this product: $25 minimum, minimum death benefit $25,000. So it does give some flexibility. As we learned last week on the term products, those start at $100,000 minimum. So the fact that this starts at 25 is a great deal. We'll go into more detail about the guaranteed cash out rider in the next slide, so we'll talk about that here in a minute. Same limits when it comes to the express underwriting, or the express underwriting as the other product we talked about. So that's a nice thing about the consistency of American National, that they provide the same levels of death benefit across all the products. So express underwriting up to $249,000, 0 to 65. The standard and substandard classes only for that. Anything above the 250 to $1 million, 18 to 50, and then it's 51 to 60 to 250,000 to $500,000. So same way we talked about in the past, just something to note. And remember, this will all be emailed to you guys, so you'll have access to this in the PDF file for your references. So these are the main characteristics of the signature GUL. Now let's go into the cash out rider and take a look and see how that works for y'all. Okay. So the guaranteed cash out rider, in essence, what this is, it provides a ability to get your return of premium. Okay. It means you get your money back. Now it's just, we have to figure out is, when do you want that money back? In year 15, 20, or 25? When you do that, in essence, what you're doing is you're surrendering your policy. You're saying, I no longer want my life insurance policy. I just want to receive, that full or partial return of premium. And then your policy will terminate upon that payment. Okay. I want to make sure that we're clear about that. You don't get to keep your policy when you get your money back. The policy ends. Okay. That's super important if you decide to exercise this cash out rider. Okay. Here's how it works. There's two different levels, between $25,000 and $249,999. And then for death benefits above $250. Okay, so there are some changes to this. So if in the lower limits, you'll see here you have 3 option years to pull out your money: in the 15th year, the 20th year, or the 25th year. In the 15th year, you get 50% of your money back, or 45% of the death benefit, whichever is less there. The 20th year and 25th year, you get 100% of your money back, again, or up to that 45% of death benefit. Typically, what we see in these is the 100% of premium return tends to be the greater amount of money. We're in an illustration here in a little bit to show you how that works. And then for the 250,000 death benefits and above, looking at 65% of premium return in year 15 and 100% in year 20 and 25. Okay, so it's a cool little feature to have. And we'll talk about here some examples of sales ideas on how this can be positioned and how we can present this solution depending on what your client is looking for. So pretty neat feature when it comes to this. And just remember, This rider will terminate when any of these happen. Whenever the minimum premium is not met, which means you're not paying the policy, that makes sense. Policies will terminate if there's no premium paid. The policy terminates or is surrendered in full. So, I mean, there are limits on these, and we'll see that in illustration. You can run it to 895, 100, 105. The last one's 121. So there are some limits depending on how you decide to run this illustration for the clients. That 61-day period of the grace period. So if you miss that time frame, those 2 months, policy will terminate. And then remember, once this rider terminates, you cannot reinstate it. Okay, so it's important to make sure you maintain this policy. Since it doesn't build the cash value like the IULs do, missing a payment, will impact the viability of this product. It's almost like I said, it's almost like a term, just on a permanent basis. So you have to make the payments. It cannot be missed when it comes to this product. Super important to do that. It has very similar riders when it comes to the children's term rider, disability waiver, stipulated premium. So just make sure you're aware of that. If you want to add this as the child's rider, you can issue it as early as 15 days after the child is born, up to 18 years old. But remember, the coverage expires when they're 25, but you can convert this policy to a permanent solution, which is a nice feature. The max coverage is $25,000 per child. Now, if you have a child and then you have multiple children after that, once this policy is in place, it will cover you or cover each child after the fact. Now, it wouldn't hurt to obviously call the company and let them know, hey, we have a new child in place, so they're aware of it. If you don't, it doesn't matter. The policy will cover each additional child once the policy is in force. And then the same type of disability waiver premium as the term. So you have to have permanent loss on both eyes. You have to, unfortunately lose both your hands at or above your wrists. Same with your feet at or above your ankle, and or severance of both one hand and one foot. And like we talked about last time, that total disability means that you're incapacitated, resulting from injury or disease that prevents you from engaging in any type of gainful employment or occupation. You have to qualify these 6 consecutive months to be able to have that disability waiver premium. So very specific when it comes to this rider. I rarely have seen it added to a policy, but if it's something that a client may mention to you, it could be something you can add on as an additional premium to the rider here. So it's something to think about when you're presenting this solution as additional features. Right, now let's talk about the sales ideas. I think these are really good ideas to think about when you're having your conversation with your clients. When they mention certain things, it might perk up your ears so you can really focus on providing this type of solution for your clients. So one thing that this policy can be used for is a potential college education funding. Okay, depending on when you get the policy and how old the child is, you can turn this into a return of premium. The premium can be used to fund college education. In the meantime, it also provides protection in case something happens to you as the parent or the client as a parent. They can complete that college funding with the death benefit. If nothing happens, get your money back. They can use that to pay some college expenses or pay back the college loans. That's one way you can use this policy. You can also use it as an early mortgage payoff. So in the future, you can protect the family while they have the home with the life insurance. But once life insurance is no longer needed, you can actually return the premium in those 15, 20, 25-year chunks and pay down that mortgage early. So one way we've seen this used is you take a look at that amortization table that the mortgage companies give you, and you try to line up the life insurance appropriately so you can see, okay, you want to pay off your mortgage in 15 years? Well, here's how much premium you would have paid in the 15th year. Here's how much you owe at that time. You kind of know how those numbers align. You can pay off the mortgage, or if it's in year 20 or 25, whatever you want, whatever that client's interested in doing. This can be a good way to set up a mortgage protection plan using life insurance. Because the nice thing about this is you get your money back. Versus with a term product, if you don't die within that 15, 20, 30-year term, there's nothing that gets paid back, and the client's out that money. And they still pay off the mortgage, but they could have used some of that money, return of premium, to pay it off. So a nice little feature to think about when you're talking to a client. It can also be used for divorce planning. Unfortunately, that happens way more than we would like in America. So it's a reality. So it's something that often in the divorce courts, there's some obviously a provision for alimony and child support. They may require a client to use some life insurance to protect against that. And parents sometimes balk at that. Well, I don't want to pay it, but I have to. But it's just I'm just spending money on life insurance I'm never going to get back. Well, if you use one of these products, you will get your money back. Okay, so there is a way. I just talked about the return of premium, depending how old the kids are, to get that money back and receive that premium, so you're not out that money in the long term. You protect your family, you protect your kids, and you get your money back. It's kind of a win-win for everybody in this situation. So something to think about if you have a client that goes through this. It could be a solution you could show them. Or you could use this also as life insurance for children from a previous marriage. So you can use this policy. This is a bit more complex, but it could be used in like a life insurance trust so that your kids from a previous marriage are protected and they receive an inheritance from you. In addition to, if you want to try to protect the first family from the second family, whatever you want to do. So a lot of different ways you can use this policy to sell it and pitch it to individuals. You can also use this policy from a business perspective as well. So you can use it to fund buy-sell agreements. Oops. So knowing that there's peace of mind for all parties, and it benefits everybody. So not only just protects the individual if they pass away, but as living benefits, there's protection there as well for your clients and for the business. So that's something we're doing. And of course, they get the money back if they decide to dissolve their company, 15, 20, or 25 years, they can get that money back and they're not out all that cash. Similar situation with the key man policy. You can protect your key people in the organization. If something were to happen to a key person, you can use the funds from this policy to help find an employee, train them, get them going, and the business is protected. And you can also, use it to benefit the deceased employee's family as well. If something were to happen to him or her, you have that policy to help the family some money and help them out during these difficult times. Then the final piece of the business is for estate purposes. So it allows you to divide the estate equally. Then you can use this money in the policy to, purchase any family member's interest from a business that you don't want them involved in the process. And that way the business continues to operate as the intended owner wanted to be. There's no infighting with different families taking, well, I want a piece of the business, but you were involved in the business. I should get ownership. Was there life insurance in place? Okay, you want a payoff? Here's $500,000. I want to buy your stake of the business. And now the business is mine totally. And now you're happy, I'm happy, and business moves on. You'd be surprised how much that doesn't happen when it comes to these businesses, to where, that there's no plan in place. There's no continuation of business in place, and then families start fighting over everything. But having a life insurance policy in place allows the existing business owners to handle that and manage the process a little bit better. Just some ideas, we want to share with you guys on gals on how to use this program, the GUL, from an individual standpoint and also from a business standpoint there. All right, so let's transition over to actually running illustrations. So let me get out of this one moment here. Go to our website, log in. You go here and you log into the American National website, and you want to go to Expert Office and go to your Expert Illustrator. Again, when I think about the GUL, is you have the ability to either do a quick quote through this term with GUL, so just give you a quick answer when somebody just wants to list a price. If you're going to do a full illustration, you come here to the Expert Illustrator and actually able to run a full product illustration. So let's go into this one because this is one that you'll probably be using the most. So you go here into Illustrator, and the first thing you want to do is you want to create a new client. All right. So let's just, again, I like to use myself here. Here's your age, a male. All right, state of Texas. You go to Action, and you do New Illustration. So when you go here, you have to pick the product. So Guaranteed Universal Life falls under Universal Life product. So that's selected there for you. And just make sure you select that signature GUL product there, and you go to create. And there you go. So you have the plan right here. You have the health class. You can pick standard, standard plus, preferred, preferred plus, whatever options you want. We either do standard, standard plus. Two ways you can solve this. We can solve it either by figuring what the premium is, if we know what death benefit we want, or if we know what amount the client's willing to pay on a monthly basis, we can figure out what death benefit that can buy. So let's just solve for premium today because we're going to look at a specific face amount. So let's just keep it at $500,000 face amount here. And let's see here. Here's the coverage options. So you have coverage options to 95, 100, 105, 121. So you can pick and choose here. It really depends on what you want to offer your clients. You can play with those options, see how they come out. Let's just do the full max amount to 121 to see what that price looks like. Okay. And we're going to pay this monthly. Okay. Now, a cool feature here with this GUL is if you wanted to, you could what they call short pay it. So if you say, I only want to pay this policy till I'm 60 years old or 65, and once I retire, I want to be done paying it. That is an option with this product. The premium will go up a little bit because now you're paying it over a shorter period of time versus a lifetime. Again, it gives you flexibility to provide that. We'll look at both options real quick, kind of see what the price difference is. So for now, let's leave it paying it all the way to age 121. We'll switch it here a little bit to age 60 and see what that difference looks like. Okay. You can take a look at the riders down here. So we have the cash out riders automatically included, same with all those living benefits. We can add that children's term or that stipulated premium if we want. We'll leave it blank for now. And we'll go to our values. And there we go. So you'll see here that for 39-year-old male, $500,000 death benefit, we're going to pay monthly. Remember, this is wish they'd do monthly numbers here, but it's just an annualized number. So 3631. So we're looking at here, let's bring this up here, a little calculator. So we're looking at 3,631. Divide that by 12. You get about over $300 a month is what it costs to have this policy in place. If I were to pay it here every single year till the day I die, pretty much. Okay, just going down. So there is that. Let's just do a quick change. Let's take a look and see if the premium changes. We change it. Let's pay it to age, let's say 65, retirement age. It's only going to pay it now for 26 years. So the value is here. And the price went up to $46.48. So about $1,000 more a year is what it costs to pay it off at age 65. So now we're looking at paying $387 a month. So it might be worth it for the client to know that, hey, by the time I'm 65, it's all paid off. And we're done there. So now let's just take a look at the illustration. So we go back to actions, and you can do preview illustration. We go here, and this was going to open up our actual PDF file. So we can review the policy here. It should just pop up automatically. There we go. It's not moving here one moment, guys. There we go. Okay. So let's go to page 1. So very similar to the term product that we've talked about in the past. So it just breaks it down real simple. You have the product here. You have the underwriting class. You see standard plus non-nicotine. You see the face amount. You see the premium amount. There's no lapse guarantee. And it breaks down. I like how it breaks it down here. The cash out rider actually gives you the amounts that they would get back. So now that we know it's over $250,000, we have that 65% of premium here for the 15th year, 100% in year 20, 100% in year 25. So depending if I want to exercise this cash out rider in year 15, I would get $45,000 back. In year 20, 92,000, 25, 116,000. So it gives you
Is
the
there a way to
actual
make it a
amount
little
of
bit
money.
bigger? Is
I'm
there a way
sorry?
just to expand? Is there a way to make it a little bit bigger?
Yes, yes.
Thank you.
Sorry about that. There we go. Is that better? Good. So yeah, so there is that 65% in year 15, 100% in year 20, 100% in year 25. You see the cash out amounts that they would receive if they were to cash out this policy at that time frame. So like a nice little feature right there in the policy. And then it has all living benefits, talks about the critical illness, the chronic illness, and terminal illness. So you can go over that with your clients. And then it just shows you, again, the cash out riders, how much would be paid back. And then it just breaks it down, the illustration there. So very straightforward, simple illustration, nice and clean. And then at the end, if you want to go look at living benefits, it breaks it down as well for you, a little more detail about the policy. So again, a good solution, depending on what the client needs. Like I said, it falls in between that term and and the IUL. So it's a good solution that may meet some of your clients' needs.